Okay, let's dive in. Welcome back to the Deep Dive, powered by Talk Tickers. Today, we are cutting straight to the core of Opendoor Technologies Q3 earnings call. They branded it the Open House live stream, which I have to admit is pretty clever.
It was more than clever, you know. It felt like a declaration. This was not your standard run-of-the-mill earnings report.
No, not at all.
This was a strategic overhaul, and it came after the stock had already had this just massive run-up.
Was it something like 309% in 3 months?
Exactly. So the market was just waiting for validation, and what they got was it was a very mixed bag, or real conflict in the numbers.
Let's hit those headline numbers right away, because
Right.
that's where the tension starts. Revenue is strong. I mean, really strong.
$915 million, which, you know, easily beat the consensus of around $82 million.
And they did say some of that was them deliberately clearing out older inventory, sort of cleaning house before winter.
Sure, but still a beat is a beat. The problem was, the bottom line, the profitability just wasn't there.
Not even close. GAAP EPS was a loss of 12 cents.
Yeah, when the street was looking for what, a loss of 7 cents? That's a pretty big miss.
And adjusted EBITDA was a negative 33 million. So you have this huge gap.
That's it right there. Strong sales, but wider than expected losses. And that's what the market reacted to almost instantly.
Oh, immediately. The stock traded down about 8.5% after hours.
And that drop wasn't about the revenue, it was about the margins. And frankly, a whole lot of skepticism about this new, very ambitious path they laid out.
The market was basically saying, okay, great story, now prove it.
And management knew that. They put a guidepost out there for Q4 right away. They guided for positive adjusted EBITDA, a midpoint of around $45 million. So the pressure is on them to show this new strategy is working, like right now.
Well, that immediate skepticism forces us to look beyond the financials. We have to talk about the huge shift they're undertaking. The new CEO called it the refounding.
Yeah, and that's the perfect word for it. The identity change is just massive. They're explicitly saying they're no longer a real estate investor.
Right, not a passive asset manager trying to predict which way the economy is going to go.
No, they're saying Opendoor is being refounded as a software and AI company. Full stop.
So what does that mean in Wall Street terms? It's a shift from being a prop desk.
Right, a prop desk, which is all about betting on the spread. You buy a house, you hold it, and you bet its value goes up. It's inherently risky.
You have to be a great housing market predictor, which is
almost impossible to do consistently.
So they're moving from that to a market maker model.
Exactly. And a market maker doesn't care if the asset goes up or down. They profit from volume, from flow.
It's all about speed and tight, predictable spreads.
The goal is just brutal simplicity. Buy a ton of homes, sell them really, really fast. The risk shifts from predicting the macroeconomy to just operational execution.
A risk that you can theoretically control with software.
That's the whole bet. And the execution changes they're making are, they're aggressive, especially on the cost side.
They use the word ruthless.
And they meant it. They talked about spending millions on consultants in the first half of the year. The go-forward plan, $0.
Wow.
They're also cutting external software. Over 20 vendor contracts being terminated because they don't fit the new AI-first model.
And you can see the result of that discipline already. The operational velocity is kind of staggering.
It really is. The speed of acquisition contracts, so the number of homes they're buying, nearly doubled in 7 weeks.
From 120 a week to 230.
And that's all enabled by the new AI. It's doing the end-to-end home scoping, deciding on repairs, costing them out almost instantly.
The detail about the workflow collapse is where it gets really compelling for me.
Oh, yeah.
They said the number of employees involved in closing a sales contract used to be as high as 11 people. And now it's down to one. One auditor just watching the machine. That sounds like science fiction.
It's a radical claim. It used to take almost a full day for an assessment. Now it's about 10 minutes.
But that's also the critical question, isn't it?
How so?
Well, what happens if the AI gets it wrong? If it misses a $5,000 foundation repair on a home? That's your entire profit margin, gone.
That is the whole risk. They're targeting a 5 to 7% contribution margin. That is razor thin. The AI has to be incredibly reliable.
But if it is, it's revolutionary. They mentioned an early D2C conversion test using the new process.
I saw that. 6 times better results than their previous efforts.
Right. And if that's true, it suggests they could massively cut their spending on lead generation, which is a huge expense.
And that's the core belief here, that this software can just eliminate human error and support this faster, tighter market maker model.
Okay, so that's the operational side. But how are they financing this whole transformation?
Well, beyond the operations, the financial foundation is getting a serious cleanup.
They set that North Star goal.
Yeah.
Very aggressive.
To say the least. They're targeting adjusted net income profitability on a go-forward basis by the end of next year. So the end of 2026.
And they're backing that up with hard numbers on cost control.
Yep. They're guiding for a $62 million reduction in adjusted operating expenses over the next 12 months, a 20% cut.
The long-term goal being to get that OPEX down to just 3 or 4% of revenue.
Which you can only do if you have a huge, scalable, fixed-cost software platform.
They also spent a lot of time on the balance sheet fix, which they really had to do.
No, it was critical. That stock run-up created a huge problem for them.
With the convertible notes.
Exactly. The stock price stayed high for long enough that it triggered a condition in their debt, which basically gave the note holders the right to demand early repayment.
Right, in Q4. That's immense pressure.
It was a very real threat. So to get some breathing room, they used their ATM equity program back in September.
The at-the-market offering.
Right. They raised almost $200 million while the stock was hot. And that cash infusion bought them the time they needed to negotiate a deal to retire most of those notes. It was a really smart, proactive move.
And then, as a signal of confidence, they announced that pro rata warrant dividend.
That was a very sophisticated move aimed right at an experienced investor audience.
So break that down. Shareholders get 3 sets of warrants, exercisable at $9, $13, and $17.
Correct. So first, it gives shareholders future upside without diluting them right now. But second, and the CEO was very blunt about this, he said it was designed to ruin the night of a few short sellers.
How does it do that?
Well, if you're short the stock, you're betting it will go down. But now you have this new liability. What if the stock goes up and those warrants become valuable?
You have to pay out.
Exactly. So shorts are forced to hedge that risk, either by buying the stock or buying the warrants themselves. It creates buying pressure and makes it more expensive to bet against the company. It's a real power move.
A sign of management's conviction.
For sure. And that conviction ties into their longer-term plan for ancillary services, embedding things like mortgages and insurance into the flow.
They made the comparison to Shopify.
Yeah, where services grew from half their revenue to 3/4 of their revenue. That's the long-term vision.
Okay, so let's connect all of this to the macro reality. Because the U.S. housing market is still pretty tough.
It's very constrained, high mortgage rates, historically low inventory. It's a terrible environment for most real estate companies.
But management's argument is that this hard market is actually good for them.
It's a fascinating argument. They see it as a crucible. It forces the discipline they need to build this deep software integration.
In a market like this, sellers care more about speed and certainty than getting the absolute top dollar.
Precisely. The new Opendoor model, with its instant AI-driven offers, is designed to capture that specific seller, the one who needs to move now. It sort of isolates them from the broader market dynamics.
They're also looking way down the road. They brought up tokenization.
Which I found really interesting. The CEO said it's not a side quest.
Right. A core effort to use things like USDC and even Bitcoin development to make transactions faster and cheaper.
It just shows how committed they are to thinking of this as a technology and finance problem, not just a real estate problem.
So let's talk accountability. If you're an investor, what are the KPIs you need to be tracking to see if this is actually working?
Okay, number one, without a doubt, is acquisition growth.
They have to prove the model scales.
They have to. They guided for a 35% increase just in Q4, and the big audacious target is to be buying around 6,000 homes per quarter by the end of 2026.
Wow. Okay, so that's the volume metric.
Yep. And number two is the margin on that volume. Are they actually hitting that 5 to 7% contribution margin target?
And finally, they committed to being transparent about their inventory health.
That's right. Resale velocity. They specifically told investors to track the percentage of homes they have on the market for more than 120 days.
Which will be in their quarterly filings.
Exactly. If this AI-driven pricing is working, that number has to come down sharply.
All right, let's transition to our next segment. And we have to be absolutely clear here. This is not financial advice.
Not in any way, shape, or form. This is purely an educational thought experiment. We are just putting on our most aggressive hedge fund hat for a minute to explore a view.
So based on everything in that call, what's the outrageous but plausible trade idea?
Okay, so the whole premise is really simple. Management's aggressive 2026 profitability target combined with these revolutionary claims about AI.
Like going from 11 people on a contract down to one.
Right. That is either a sign of truly brilliant executable strategy or it's just aspirational hopium.
And given the stock drop, the market is pricing in the hopium.
It is, and that creates a potential asymmetric opportunity if you believe in their ability to execute.
So what's the structure of the trade?
You want to give them time to prove it, so you look out pretty far. The trade is a leveraged call spread expiring in Q1 2027.
Okay, so a 2-year runway.
Exactly. The structure would be buying long-dated, deep-in-the-money calls. That captures the maximum upside if the turnaround is real.
But those are expensive.
Very. So you partially fund that premium by selling a tranche of calls with a higher strike price, maybe just above that $17 warrant level. It's a way to get leveraged upside if they hit their targets and achieve profitability in 2026.
And the outrageous part.
The outrageous part is the level of certainty you'd need to have that their execution in 2026 can overcome all the headwinds we see in the housing sector today.
So to sum this all up, the message from the open house call was crystal clear.
Oh, yeah. This is Opendoor 2.0, and they are playing offense. Full stop.
They're moving from being a risky asset manager to a focused software-driven market maker.
Backed by this powerful AI narrative, these ruthless cost cuts, and a balance sheet that's been cleaned up to give them the runway they need.
But the ultimate question remains, the one for you, the investor, to really think about. Can this aggressive execution and all this software automation truly isolate a real estate company from the massive, persistent problems of high mortgage rates and low inventory?
The problems that have plagued the entire sector, the market's initial judgment says prove it. But you look at the CEO's track record at Shopify, where he promised a very similar rapid turnaround.
It makes you wonder.
It does. It makes you wonder if validating that Q1 2027 call spread might just be a little more plausible than the current price suggests.